I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Jeff deGraaf on the line. He is chairman, co-founder, and head technical analyst at Renaissance Macro Research. Jeff, how you doing this morning?
Very well, thank you.
And you spent some time on the street. Tell us about a little bit of your career at Merrill and Lehman and how you ended up in your current position.
Well, geez, I've been around for years. First at Merrill Lynch, and then moved over to Lehman Brothers in the mid '90s. Worked under a fabulous technician by the name of Steve Shobin, and who helped teach me some of the tricks of the trade and better understanding of some of the historical values of or importance of the discipline. Steve moved on in 2000, and I took over the department at Lehman Brothers and moved to number one II in relative short order. And just this year was celebrated our 10th anniversary as number one in the II department for technical analysis, and made it into the Hall of Fame. So the good news on that is I guess people appreciate our work. The bad news is that means I'm getting old. So
Yeah.
that's where we are.
Where are you from?
I'm sorry?
Where are you from?
I'm from Kalamazoo, Michigan, of all places.
Yeah, and I just noticed here you snuck on the show here. I have to have a little talk with Brianna here. You're a graduate of that other school in the state of Michigan.
That is exactly right. I bleed green and white. So
Okay.
you know, so far this century, yeah, I guess it is a century, but this decade is at least a little friendlier to our football team than the other schools. But being in this business, I know about cyclicality. So
yeah, I hear it from Matt Kolb all the time. I'm a big Michigan fan, so we got the showdown on Saturday. I don't even know if I'm taking the 17.5 points. But let's get to the markets. I saw you got some nice ink and Barons over the weekend, and you're just analyzing this quick rebound from when you're looking at it technically. I mean, we had the washout, the Ebola fears, market got creamed, and now we've just come right back up. I mean, is this a healthy and sustainable rally?
The up too far too fast is, I think, one of the biggest misunderstood parts of the street. Because when you have good legitimate momentum, that's exactly what happens, and people sort of are scared. They don't want to sort of buy into that because they feel like they're maybe the greater fool. And we don't actually find that tends to resonate or bear itself out through history. Now, it is important, though, and what we don't have in this rally is really good internal momentum. And when we talk about internal momentum, we're talking about breadth and the way volume is divided amongst advancing versus declining names. So even though the price has been strong, the breadth has been a little lackluster, and that's what has us concerned. Because we would marry that with, frankly, the previous 4 to 6 months of absolute breadth deterioration. You've seen it in the small caps. You've seen it in gold, for that matter. You've seen it in oil. There's some big tops forming. So we think the burden of proof is on the bulls, not the bears. And even though the market was strong, and usually or historically that's been a pretty good sign, the internals just don't back it up. So here you are or yesterday at 1950. That's right in that resistance zone that we were looking for. It matches the retracement for the Russell 2000. So I think we've got some wood to chop right here, and I think there's some consolidation. Very unusual that you would not have some type of retest period. So it's a little dicey in here, and I'm not fully endorsing the move off the lows because it just didn't have the same type of internal momentum that we find to be so powerful and so endemic of a sustained or resumption of an uptrend.
Okay, and I'm looking at some of your notes here, and you're pretty technical, as myself. What are some of your staples of your technical analysis? Are you moving averages? Are you MACD? What's your go-to technical analysis technique?
Well, we tend to back things up with pretty rigorous statistical work. For mean reverting techniques, we use things like the augmented Dickey-Fuller tests. I mean, some of these high-end math formulas. But what we're really basing our analysis on is momentum and trend, because in all our work that we've done, we find that works the best over the course of a career. And so, that would support things like a MACD. That would support things like moving average crossovers. That would support things from our standpoint, which would be internal forces like breadth and the volume flows that I discussed earlier. We're big users of sentiment to try to capture points where people are offside, so using things like skew in the options market. So those are some of our go-tos as we think about the world on a day-to-day and weekly basis.
Is there anything that's looking good on the rally? You talked about the technicals and getting down to it. Is there anything that held up pretty well on the decline and is looking good on the rally?
Yeah, I mean, I think what's most interesting is the leadership going into the decline looks like it's leadership coming out, and that'd be biotech, it'd be healthcare providers, it would be some of the insurance names, it would be transportation names. I think one of the big things here, and this is a theme that we've hit on now for a couple months and just continues to pay dividends for us, is this shift to quality. And there's a lot of different ways to define quality. We use a modified return on asset formula. But if you look at the performance of high quality versus low quality stocks, and I know a lot of people like the idea of I only buy high quality, but I can assure you, particularly with an activist Fed, there are plenty of points in time that being long low quality and short high quality has been a much better trade. What we find though is when the Fed is coming off of a liquidity binge, whether that's QE or easing or whatever the mechanism is, usually that's the point at which high quality starts to outperform low quality, and we've started to see that since the middle of the summer. It continues to work, and I think that's going to be a theme that probably sticks with us into 2015. So, high quality to us is the place to be. That's also a direct beneficiary of the strong dollar trade, because it implies capital inflows, and those names tend to those dollars tend to gravitate towards high quality names. So, that's one area as a distinction, within stocks that looks pretty interesting to us.
I know you like to look at the broad market and then also vis-a-vis, the Russell 2000. And, this has not shown any signs here. I mean, it has recovered off the lows. Number one, it peaked ahead of the market back in July, made its all-time high, gave away sooner, and just, the chart on it, if you look at the daily chart of the iShares Russell's 2000 ETF, which I have on the screen, it looks broken. It looks like you had a decline, a rally, then you had a further decline, and now you're just having another rally. Is that part of your thesis on the overall market?
It is. And we'll use the value line geometric index because it represents the average stock, so they're not cap weighted, but it gives you a really good representation as to what's going on sort of underneath the surface, and that's been in a similar configuration as the Russell. It's not quite as bad because of some of the weightings in the Russell, but it's absolutely clear that there's a top formation in the Russell 2000. I thought what was interesting yesterday is it got right back to the resistance zone, or what we'd call the neckline in our business, and had this outside reversal day where the index gapped higher in the morning and then actually closed below the previous day's low. It was just an ugly day, and that obviously started to weigh on equities in the large cap S&P as well. So yeah, I think there's a message there that has to be heeded, at least as it applies to the average stock. And I think the risk to our call here, which is, look, we think we're under a distribution process, and the S&P is has a pretty good probability of topping because the Russell already has shown you that. I think the risk to my call is that we could enter into one of these high-quality, very select markets, call it the Nifty 50 of 2015, much like the early 70s, and so it can drive the averages higher, but the average portfolio manager and the average trader is not participating as just a very select few names drive the indices higher. That's my biggest concern for 2015 as we view our call today.
Okay, and also we, talked about, this rally being, driven by the Fed, by QE, quantitative easing. They've set a signal that, hey, it's supposed to end this month, or, the tapering is in effect. What about it? I mean, isn't this a kind of a signal to sell the market? Is that when people have asked me my long-term opinion, I'm like, hey, as long as QE is around, as long as the Fed's pumping money into the economy, then we're good to go. Is this a sign, or perhaps an upturn in interest rates where people will flee the market to go into more, interest-bearing investments?
If you look at the history of QE, and more importantly, QE termination, it has done, particularly in the bond market, the exact opposite of what the chalkboard would have suggested, right? People would have expected that when the Fed of all buyers, who's not price sensitive, comes into the market, you are absolutely going to end up with lower yields because they're going to drive interest rates lower. Well, the absolute opposite has happened each and every time because it puts people in a risk-seeking mode. And so, why not sell my bonds, my safe assets, to a price-insensitive buyer and turn around and use that money to buy risk assets? And just the opposite happens as the Fed starts to exit those liquidity programs. So, we had a call about 3 weeks ago that we thought the bond, the 10-year, would trade under 2%. Now, our call was for the end of the first quarter. We got it within 3 weeks. But it is a very clear pattern that when you take quantitative easing off the table, bond yields go lower, not higher. And there's no evidence, at least from our standpoint, to suggest that this time's going to be any different. So you ask me what I'm bullish on and maybe what's sort of an outlier call, I'd still be bullish on the bond market.
And if you're going to
bearish on yields,
well then, so then you got to be looking at some utility stocks then, and slow
absolutely.
and steady.
Those are setting up very well. We put them in our daily today. They're in these nice consolidations. They're breaking out. They look very interesting. The REITs, we had a call on the REITs back in October when early October, when we made the bond call that, hey, if we're even close to being right on the bond market, REITs are probably the next step in the thought process, and those have worked and continue to work. But you're right, the utilities at this point look more interesting because they're just emerging from trends versus or from bases versus the REITs, who have been in an uptrend for the last several weeks here.
Could you give us some examples, some utilities that are on your radar?
Oh, Exelon is one that stands out. Dominion is one that stands out. I think Sempra Energy was one that stands out. These are, we like to find those sort of smile formations that extend somewhere between 3 and 6 months, and those are the ones that are most interesting to us.
Smile formation.
So anything that's got that smile looks great.
All right, clue us in. What's the smile formation?
Well, the smile is just simply a base. It's like a mini saucer, right? So if you look at it and it's got this 3 to 6 month smile, those are usually pretty powerful formations, particularly after they break out and give you some type of volume confirmation.
Right. So you're looking at the yield on these stocks. I mean, I've always been a big proponent of 3, 4, 5, 6% yields, and here you get the yield in these stocks with some chance of capital appreciation as well. So that's something to keep an eye on. You mentioned the Nifty 50. Stocks that you could just power the market higher. Who do you put in that category? Do you put the big caps like your Apple, your Exxon Mobil's, and Microsoft's in there, or who are your candidates for you?
Yeah, I mean, we would, if we distill that down to quality, right? So if this Nifty 50 becomes a quality theme, then the majority of the quality names are dominated in terms of cap by healthcare and by tech. So that's Microsoft is in there. I think Bristol's in there. I don't have the list in front of me, but the sort of the big heavy quality names as defined by margins and asset turnover certainly apply. And in our view, when you look at the post QE environment, quality outperforms low quality, and these mega cap quality names are probably going to be the ones to be in. So. And most of them have held up very, very well here. I mean, IBM would probably be the exception. IBM was considered quality in terms of our quantitative discipline. It's not a good chart. It wasn't a good chart, but it didn't hold up. But the rest of them, I mean, thinking in terms of sectors, it is healthcare in terms of the top, technology second, and then discretionary and consumer are tied with about 8% weighting apiece. So it gives you some sense whether you want to play through ETFs or whatever.
Any large ADRs in that list?
No, this is all domestically focused. And that's the other thing, too. If you look at the factor, so the factor that's been most reliant in the last 1 month and 3 months in terms of performance versus outperformance, by segregating the S&P, the top 20% S&P names from the bottom 20% S&P names, as defined by foreign sales as a percentage of total sales, has been the single biggest driver that we've seen in terms of factor work. So in other words, those companies that have a domestic sales base have done extraordinarily better than those that have a high percentage of their revenues coming from overseas. Now, part of that's the global economy, so this isn't a big surprise, but it has had a big impact on the performance of those companies. So you've got the stronger dollar, you've got the performance of both EM and obviously Europe and even Japan, and that has really forced the returns into those domestically focused names. And we think that'll continue. There's no reason. When we look at the dollar's still actually just broken out of a massive base formation and still looks to us like it has embarked on a multi-year uptrend. And I think that theme will continue to play itself out in the months and quarters ahead.
Okay, final question for you. I mean, I read your comments in Barron's, and I've been observing your daily reports. And what's interesting to me is that here you can put out these daily reports and whatnot, but you talk about 2015 and looking out and more longer term perspective. Is there anything that you really keep an eye on during the day? That really kind of in your gut, you're following a certain. I mean, for me, it's the S&P 500 futures. Really don't pay that much attention to the cash, the price activity, and that. Is there something that on a shorter term basis, since we have shorter term traders, is there something that you really follow closely intraday?
Well, most recently, we found an extraordinarily high correlation between short rates, call them 2-year yields, S&P futures, and oil futures.
Okay.
And you can pretty much trade, maybe not tick by tick, but certainly within 15, 30-minute swings of a breakout in one and a non-confirmation in the other, and pair those off and see some reversion. So we've got different ways that we measure that to give us some sense as to when that that's an extreme, and we'll go after it. But those three things, I mean, it's on my Bloomberg, every second of the day as I'm going through and just sort of monitoring things tick by tick. Those three things, 2-year yields, S&P futures, and crude oil futures have been extraordinarily linked over the most intermediate term, and probably will be as we get these monetary dislocations throughout the globe. I think there's going to be more and higher correlations intra-asset than what we've been experiencing over the last couple years here.
Great information from Jeff deGraaf, chairman, co-founder, and head technical analyst at Renaissance Macro Research. Great information, Jeff. Thanks for coming on. We certainly like to have you on again.
Thanks for having me, and go green.